factors work in unison. Like that. Then you're saying that the past price movements assist in prediction of future price movements or trends. So you're saying the use of graphs and charts can be able to dictate or provide some bearing as to which direction the share price will move. Is it either going to be 1, 2, or 3 right there? So that is what you're saying. The analysis of past price movements like that can be able to dictate the future price movement in at least the short term. There. Now, having looked at the technical analysis principles there, let's look at the logic behind the technical analysis there. Logic behind technical analysis. There. Now, the best way to describe the logic behind technical analysis is to use a graph. A graph of price against time is the best example that we can be able to use to try and understand that concept of technical analysis. So we're saying this is the price there, and this is time there. So we have the old equilibrium price there. We have it going down like that, and then we have like that. So we can be able to say this is the old equilibrium price, because you are plotting a price against time like that. Then this is the new equilibrium price there. This part right here is when the information is being released into the market. So when the information has been released to the market, investors decide or that they're not going to take up the new security, or the company's mechanics or specifics dictate that it should be able to go down there, and less demand for that security will reduce the price of that security. So we say here is release of new information. Let's go. This is just a hypothetical example. It could be also the other way around. So we could have like that, a graph up to there, then it goes like that, and then you can be able to put it something. I need a change in my life, because say this is the old equilibrium price is much lower, then we can be able to have the new equilibrium price being much higher as compared to that. But this is just a simple explanation that can be able to guide the logic behind technical analysis. So that is what we have there. Now, having looked at the logic behind technical analysis there, we can be able to look at the types of charts and use a technical analysis. So we move on to look at the types of charts and use technical analysis there. I hope this has actually provided some guidance. The logic behind technical analysis is simple. You just need to plot a graph of price against time, and you understand the impact of release of new information. Once information has been released to the market, then that creates or arouses some interest or disinterest. Meaning that in this case over here is a disinterest. This first of all, this first graph that is over here. The old equilibrium price, the price was much higher over here. Then the release of new information, possibly negative information, reduced the amount of demand for that security or asset, and hence now the new equilibrium price is much lower than the old equilibrium price right there. However, in this dotted line which I've drawn moving up like that, this part over here indicates the old equilibrium price which was much lower. The release of new information within that part over here aroused interest or aroused some form of demand for that security, so that you can be able to see over here that the new equilibrium price is much higher than this dotted line which began over here. So the logic behind technical analysis is just driven by forces of demand and supply. That is what I can be able to explain under the logic behind technical analysis. Now, moving on, let's look at the types of charts used in technical analysis right there. So I can come on this side here. look at the types of charts. So types of charts used in technical analysis. Now the first type of chart that we are going to look at is point and figure chart, or rather let me start first of all by looking at the line chart. Yes, let me just start right here. I'll be able to explain all of them anyway. So the line chart. Now a line chart is a simple plot of price against time. Now this is how I can be able to demonstrate a line chart. Now we are saying here we have price, that price against time, that, and as time goes by, the forces of demand and supply changes the price of the security or the asset. So you can begin there, it moves there like that, it moves down like that, moves as it moves up like that. So we are saying this is a line chart there, indicating this as time is moving at this part over here, you can see M is different from this part, it's different from here, and so on and so forth, and like that. That is what we're saying is a line chart. We just plot the prices against the time, or as time moves on, you can be able to plot the security and price pattern. So this is a line chart there. Now we look at what a bar chart is. A bar chart right there. So a bar chart is a chart that is drawn like so. You can draw it right here. That. Then we can say that this is just a plot of price still against time. That. But now in this instance, what will happen is that we are going to plot now the starting price, the opening price, and the closing prices, and like that. Here is the midpoint there. Then as we move on like that, we plot like that, a bar chart like that, and so on and so forth like that. So you can be able to clearly see that this is an uptrend, or the trend is moving in that direction. As well in the line chart, you can also see this an uptrend moving in that direction. However, if it's moving down like this, say from over here, we can be able to decide maybe it goes down like that and moves down, moves down like that, and this is now a downtrend that is moving like that. That is what we can say is a bar chart. So you can indicate over here, just over here number 2, bar chart. Now having looked at those two, let's look at now the point and figure chart. The point and figure chart right there.